How the world's banking system really works. Every day you tap a card, send a transfer, or receive a salary. Numbers change on a screen and you assume that your money is safe and available. No delay, no warning, no visible effort. But behind those simple numbers lies one of the most complex and fragile systems in the modern world. If you enjoy understanding how the world really works, subscribe to the channel and turn on notifications. Every week we reveal the hidden systems you depend on every single day. Your money does not live inside your phone. It does not sit as stacks of cash inside your local branch. It exists inside a network of digital promises, accounting entries, and interconnected institutions. Today, we are going to follow your money from your bank account into the global banking system. Most people think of a bank as a safe box for money. You deposit cash, the bank keeps it, and you withdraw it later. In reality, modern banks do something very different. They transform short-term deposits into long-term loans and create new money in the process. When you see a balance in your account, that number is not a pile of cash waiting for you. It is a liability of the bank, a promise that the bank will pay you when you ask. Banks sit in the middle of a web of promises. They owe money to depositors, and borrowers owe money to them. Let's start with your salary. Your employer sends a payment to your bank account. You open your banking app and see your balance increase. It feels like money appeared instantly. But what actually happened is an update in the bank's internal ledger. The bank increased the number assigned to your account and decreased the number assigned to your employer's account. No physical cash moved, only records changed inside databases. When millions of people receive payments at the same time, banks process enormous volumes of these digital updates. Each entry must be accurate, synchronized, and reconciled with other banks' ledgers. Now imagine someone else wants to buy a house. They apply for a mortgage at the same bank where your salary was deposited. If the bank approves the loan, it does not go to a vault and pull out your money. Instead, it creates a new deposit out of nothing, simply by typing new numbers into the system. On the bank's balance sheet, the loan becomes an asset. The new deposit in the borrower's account becomes a liability. This is how commercial banks create most of the money in the economy. Not by printing paper, but by expanding balances in digital ledgers. Of course, banks cannot create infinite money. They are constrained by regulation, capital requirements, risk management, and the need to stay solvent. If this type of behind-the-scenes explanation interests you, make sure you are subscribed. Upcoming videos will explore global logistics, waste management, and supply chains in the same invisible way. Behind the scenes, banks also hold special balances at the central bank. These balances are called reserves. Reserves are the money that banks use to pay each other. When you send money from Bank A to Bank B, the public sees a transfer between two accounts, but the real settlement happens between banks' reserve accounts. The central bank operates the core payment infrastructure. It keeps the master ledger that records how much each bank holds in reserves. When Bank A owes money to Bank B, its reserve balance goes down. Bank B's reserve balance goes up. Reserves are the foundation on which the entire banking system stands. If a bank runs out of reserves, it cannot settle its obligations to other banks. When you send money to a friend who uses a different bank, the process looks simple. You enter an amount, press send, and the balance changes on both phones. This hides a complex choreography. First, your bank reduces your balance in its internal ledger. Then, it sends a payment instruction through the national or international payment network. At the central bank, reserves are moved from your bank to your friend's bank. Only after this settlement does your friend's bank increase their balance in its own ledger. For small payments, this may happen in batches, several times per day. For large transactions, it can happen in real time. From your perspective, everything is instant. From the system's perspective, thousands of messages and balance updates are taking place. The entire banking system depends on one fragile ingredient: trust. Most depositors leave their money in the bank because they believe they can withdraw it later. They do not all show up at the same time asking for cash. Banks use this stability to lend most of the money out. They keep only a fraction as liquid reserves and cash. But if many people lose confidence and demand their money at once, the bank cannot pay everyone. It does not have enough liquid assets to meet all withdrawals. This is a bank run, a self-fulfilling panic that can destroy an otherwise solvent institution. To prevent this, most countries have deposit insurance and lender of last resort facilities. These mechanisms are designed to reassure depositors and provide emergency liquidity in crises. Because banks can create money through lending, they are heavily regulated. They cannot simply lend without limit or quality control. Regulators impose capital requirements. This means banks must fund themselves partly with equity that can absorb losses. If too many borrowers fail to repay, the bank's equity is wiped out. Once equity is gone, depositors and creditors are at risk. Regulators also monitor liquidity. They require banks to hold enough liquid assets to survive stress scenarios, where many depositors withdraw funds at the same time. Stress tests, reporting, and supervision exist to keep the system stable. But history shows that regulation reacts to crises more often than it prevents them entirely. Banks are only one part of the broader financial system. Around them exist investment funds, insurance companies, shadow banks, and capital markets. Banks lend to each other in overnight markets. They buy and sell government bonds and other securities. When conditions are calm, this network of relationships increases efficiency. When conditions are stressed, the same network can transmit shocks quickly across the system. Trouble in one institution can spread to others through credit lines, derivatives, and shared exposures. This is called contagion. Central banks and regulators watch these connections closely. They know that the failure of a large or interconnected bank can threaten the entire system. In recent years, banking has become almost completely digital for many people. Branches are closing, apps are replacing cash, and payments are becoming instant. New players like fintechs and digital wallets now sit between customers and traditional banks. They offer sleek interfaces while storing money in regulated institutions behind the scenes. Real-time payment systems allow transfers 24 hours a day, every day of the year. What once took days now happens in seconds. At the same time, central banks are exploring digital currencies of their own. These could give the public direct access to central bank money through digital wallets. If that happens, the traditional role of banks as deposit takers may change. They may focus more on credit allocation and less on storing everyday money. Clean water, electricity, internet, and banking all share the same pattern. They are complex, mostly invisible systems that you only notice when they fail. If payment systems stop, salaries cannot be paid. Businesses cannot settle invoices. Trade slows or stops. Banking crises are not just financial events. They are disruptions to the basic plumbing of the economy. Every number you see in your banking app is part of a vast interlocking web of ledgers, reserves, regulations, and trust. As long as that web holds, money moves silently and reliably in the background. The moment it breaks, modern life feels it immediately. If you want to keep understanding the systems that silently support your daily life, subscribe to the channel and turn on the notification bell. In the next video, we will explore how global logistics move physical goods across oceans, borders, and warehouses, to finally reach your door. That is how the world works.